Welcome to the KE Report. This is another special daily editorial that was recorded from the floor of the New Orleans Investment Conference. I held this one to Sunday because it's not as, let's say, market timing specific that most of our daily editorials are. This is a conversation with Charles Funk, President and CEO of Heliostar Metals. We don't talk too much about Heliostar, though. We more focus on the market environment for the resource sector broadly when it comes to financing, how to get either projects financed, how the money filters down to the mid-tier, to the junior companies, and how that's changed over some of Charles's history in the resource sector. It's a very interesting conversation, really opens up a whole lot of other questions about what more the sector can do and what challenges, quite frankly, the sector continues to face for companies funding their projects and their plans. I hope you all enjoy this interview. Again, it was recorded back last week at the New Orleans Investment Conference. All right, now sitting down with Charles Funk, live from the conference floor. Charles, thanks for joining me today.
Thanks very much for having me.
So, Charles, we're going to take a bit of a different direction with this interview. Look, we update our audience a lot on what Heliostar is doing, that transition from being an explorer into an actual production, a mining company through acquisition. When we were sitting here at this conference, we were talking about how the financial markets, how they've impacted the mining business. We see major companies going after these massive deposits simply because, well, they need to. They're big companies. But there seems to be this maybe sweet spot, you could call it, in these mid-size mines that actually make money. Take us through how you're viewing and how you've even used this different concept to now create, in a sense, a mining company.
It's a good question. I think there's almost a push factor and there's a pull factor into that space. And so what I mean when I talk about the push factor, it's pushing you out of the junior space in the sense that I've been involved since I came to Canada in 2016 in junior mining companies. And I think in the bigger picture, the financial model for financing junior exploration and development is broken. And there's many factors behind that, but I think one of the biggest ones is that brokerage firms don't get paid for trades these days. And so that removed the core cash flow generation that then supported them to do quality research, to pick higher quality names to back and represent and go. And there's going to be a newer, we're never going to stop financing R&D in exploration and mining, but I think there's a transition that no one's quite sure how we get from there to here. And what one of the intermediate steps has been, instead of more financing going to quality companies because good research is being done, dare I say bankers aren't the greatest picks of exploration opportunities. With that research group taken out, it's gone the other way, where the money's still being raised, but the victim is the junior mining company. The fees that come out, the recycling of capital every 4 months when the hold comes off in Canada to chase the next stock to get returns from investors. So to be a pure exploration company is extremely difficult today and has been for at least 5 years. I think it's extremely difficult to continue to raise capital and then to not have your shareholder base sell out on every small spike that comes. And so I see that what I saw as a junior company is that we were the product, we were the victim. The bankers don't really care whether we succeed or not as long as they can churn that capital and get their fees. So my view was being small, with the costs of being listed on the exchange, with the difficulty of raising money, isn't a particularly attractive situation to be in. That's what I think is the push component of leaving that space.
Well, and I think a lot of companies want to leave that space too, right? You don't want to be slaves to going back to the market over and over again. But then you tie that in with the majors. A lot of juniors are looking to the majors to say, A, what are the majors looking for to be acquired? And B, how do I get them to invest in our company or even better, acquire us? But there's a long road there. So I feel like this whole model has changed where we see a lot more companies chasing production. However, building mines is very difficult, and we've seen a lot of mines go under, and sometimes it's that churn of the third company that actually gets the mine that makes it successful. Sometimes it just isn't successful. So as a company representative, how do you find that sweet spot? You can be mining, but how do you make sure that you're making money while mining?
It's funny, I had a spot talking before, and this is a capital-intensive business. And so paying cents on the dollar for sunk capital is an incredible way to make money for your shareholders. But when you look at that...
Is it, though? Is there such a thing as sunk cost that actually matters?
Yes, clearly. And so take, for example, our assets. If we talk about Heliostar, not more broadly, I'm not sure whether that's your intention, but let's use it as an example.
Go that direct.
Anna Paula had $100 million invested in it. That's 140 kilometres of drilling, that's a decline, that's a 53-man camp, that's surface rights purchased. That is going to take 50 to 100 million off the capex of us putting that into production. This is not speculative R&D or exploration that didn't work. This is legitimate infrastructure built or purchased that exists that we paid 10 cents in the dollar for. So in that case, I think that's real. Where I think the next consideration of that as assets is there's a spectrum. There's everything from high quality assets where management or financial leverage cause them to fail, to low quality assets that are doomed to fail. Anyone, no quality management team, no amount of money will fix that problem. So just because it's had capital sunk into it, I think is where you're heading, doesn't mean it'll work. But there's, take it like farmland. There's farmland where the farmer tried to buy another farm, borrowed too much money and it didn't work. Doesn't mean the original farm isn't fertile ground. There's other farmland that's desert where it never rains and you'll never make money. So to bring it out of the mining space, I think the other way that's interesting is portfolios. We all, when we're doing things in our personal lives, pay more attention to some things than other, and that means we're not allocating the full value if other things were a singular focus. So I think when you buy portfolios, you can get misallocated value or sunk capital that isn't being recognised or fully valued. So I think there's a couple of ways to do it. Look for management that hasn't unlocked value, look for financially distressed circumstances that aren't the problem of the asset, or look for portfolios if you're talking about sunk capital.
Now, what about the financial sector in general? Markets have gotten bigger, I think. Well, they undoubtedly have gotten bigger. Look at the market cap of tons of sectors. They've gotten bigger. Mining, I feel like, has almost been stuck in this world where it has gotten bigger, but not to the same extent. So that means not as much money is chasing this sector. Is that because of the financing issues? Is it because we haven't had so many success stories, or is there something else at play that I guess investors just aren't taking notice of mining companies, let alone the juniors?
Well, I think, first of all, fundamentally mining's a horrible business model.
Seems like it.
Anything, and just take it back to its first principles. Anytime that you put together a resource base that's really hard to find, whether that's a pile of widgets or a copper mine, and then you actually deplete those, it's unlike a bank where the money goes in the bank and it stays there and you get a return on that investment. If we didn't fundamentally need metals, commodities, financial instruments that weren't manipulatable, then we wouldn't be in this business. This is kind of the least worst way to create something that's fundamental for the human standard of living. I think we have to acknowledge that first. But there is ways that we've talked about in other means that you can make a good return, a good investment. Quality teams who can access capital can do R&D really well. And I think I touched earlier that there's a push and a pull. For us, having built Heliostar, I think there's something that's really pulled us into this space in that I always want to build businesses where there's a lack of competition. Whoever has the lowest cost of capital wins. And so you have to find something unique because when you're starting a new company, you don't have the lowest cost of capital. And I look back, since I left the major mining companies over, about 12 years ago now, I worked for Newcrest, then I came to Canada and watched these companies. When I was with Newcrest, 100,000 ounces a year was a minimum hurdle that we would look at as one of the biggest 5 gold companies in the world. And I think ETF buying's had an incredible impact on our industry in that gold companies have created these mega mergers, Barrick, Randgold, Newmont Gold Corp, Newmont, Newcrest, Agnico acquiring significant assets to grow the business, has meant that as they've got bigger, their production bases had to get bigger to justify it. If you're those big guys, small production doesn't move the needle and takes management time, so you get rid of them. But maybe a more nuanced view of that. Most deposits don't start at 250,000 ounces or 500,000 ounces up. And all of these major gold companies are saying this is our minimum hurdle to start. And what I think in what's drawn us into this 100 to 250,000 ounce production space is many great businesses. You know, you look at the old Wheaton River, Yamana, Kirkland Lake, just to pick a few across the cycles, have started in that space. As a geologist, if you look at a distribution of the size of producing gold deposits, like only 5% would be in that 250 plus. Most of them are probably in the 50 to 150,000 ounce a year range. And so if you're trying to say business that I'm only competing for the rarest of assets, growth is incredibly difficult. And you've seen that. The big companies are celebrating that they can stand still on their production profiles. So I think they're abdicating the space. There's some old studies out, and I'm only talking anecdotally here. It's a long time since I was told that the first resource on most of Newmont's major mines about 15 years ago ended up being only 15% of the total endowment of the district 10, 15 years later. Gold deposits grow and mines have historically expanded out of positive cash flow. And so I like this space that we're building Heliostar in because it's where most of the gold deposits naturally start production at. And my view is if we have 5 in that range, we'll probably be let down. We'll make wrong technical decisions or have a problem with one of them. I think 3 will probably be as advertised. And given that we have a nose for projects that grow, I think 1 has the potential to grow into being a tier 1 gold deposit. So I think it's the happy hunting ground to start gold businesses that could grow into a much bigger business. It's a long-winded answer. It covers a lot of topics. Sorry.
Sounds like you're going through that whole acquisition strategy too, right? It's hard to start from grassroots and then grow it from that aspect, but then that brings us back to the start of where does that leave the junior market, right? Juniors are out there exploring, but they can't grow to the size that majors want in a reasonable time frame. So is it the mid-tiers? Is it these early stage miners that could provide that capital to the smaller companies, or are they also stuck investing it back in their own assets?
I think you're seeing the self-correction in the cycle, in the sense that it gets hard to raise money, hard to do exploration, hard to make the discoveries that bring assets online, and that ultimately fundamentally leads to higher prices. And then higher prices attracts capital, risk capital. So we're seeing it right now. We're seeing the consequence of well over a decade of underinvestment in growth, and that's leading to 20, 30% year-on-year increase in commodity prices. That will, it's not yet, but that will ultimately attract capital. And then the smart people, the money will initially flow to the smart explorers. And they'll deploy that capital very well, and they'll get a return on that investment. Just treat it as R&D. The smartest scientists do the R&D, get the money. And then what happens is then that tide floats all boats. Everything starts going up, and then anyone who sounds smart gets money. But we know we're in a jargon.
We're not there yet.
We're nowhere near there, but this is the big picture cycle. And then anyone who can tell a story gets capital. That capital gets deployed poorly. The industry gets a black eye. No one invests in capital. It drops off. And that's the continuing cycle that we live in.
What about metals prices? How do they impact all this? Because, look, I don't know of very many projects that don't look like they would make money at these current prices. However, does it mean that they should be built? Probably not. So how do you discount where metals prices are now with where they could be in the future, and even more importantly, where they would be in a cycle when it's moving back down, correcting?
That's a tough question as someone thinking about bringing on production.
Multiple production.
Yeah, in the sense that the attraction of assets that can last cycles is as long as you can survive one, you can survive multiple. In that gives you a chance to reinvest and grow. My view is I don't particularly take a view on metals prices. I think you should keep a healthy conservative level below those for the base economics. Don't build a marginal mine hoping the gold price will improve, because costs will go up and it'll always be marginal. So we've always focused on high grade deposits for that reason, because then, like, if you look back, take mining back 200 years. If you went out and staked something in Western Nevada and it showed gold in the vein and you went down and it was there, you could employ your mate, and then you could employ some people while you took the weekend off, and then you went into management while they mined for you, and then you built up cash and you put a second, or you bought your neighbour's claims. Mines were built at a positive cash flow. When you move into this sort of more modern, more financially driven world, then mines are built on big debt packages. And so I think that's when you get these low margin mines built, because this idea that you build scale, people will come, companies get bigger, it seems attractive. I always think mines should fundamentally be profitable, should be able to pay back their capital, and if the project then justifies it, well, then you return and you scale up. I don't think that's changed historically. It just gets distorted when money gets easier in boom and bust cycles.
Well, and that ties into the financial markets, right? Is that what investors are looking for, or are they looking for that big win? I know it takes longer. So are the financial markets, again, kind of hurting mining because of the aspect that it takes so long to be big?
Yes, there's a fundamental disconnect between people invest for one reason. They want to make money.
Sooner rather than later.
Yeah, and the sooner the better. There's nothing dishonorable about that strategy. We all want that. The reality of this business is it's not an overnight business. And the most difficult part of this business is building a mine takes more than one cycle. And governments and permitting in particular, I think, is the biggest culprit behind this. It's turned what used to be sort of 1 to 2 year timelines into 5 to 15 year timelines. And now a junior mining company cannot go through and build a mine in a single cycle, meaning that it will have a weak point, meaning it will have a dilutionary event, which makes it very hard for people. So then people are focused on, well, can I cherry pick the Lassonde curve? I think we see and admire the smartest investors in this space can keep their capital in this space throughout cycles. But most people are trying to make money in the cycle, and that leads to a dangerously short-term view that does negatively impact capital allocation in the industry, and therefore means promotions and short-term thinking gets a precedence that it shouldn't have, and that in turn leads to a bad reputation globally for the sector.
What about that whole aspect of financing mines and then even financing growth in mines? We hear a lot of companies, because they're forced to, say, we're going to do debt, equity, stream, royalty, everything's on the table because, quite frankly, their market cap's so low that it needs to be. But does that work for mines? Does it work to start a mine that way? Does it work to build a mine through that?
The short answer is yes. Talk about, again, build it back to any investment, whether it's a business, whether it's your house. You can wait forever to save that money up and hope that you're ahead of the inflationary cycle to afford it, or you can leverage and you can take on debt to do that. In the case of people's homes, the combination of typically a discounted tax rate on them and an ever-increasing demand for property makes that a good investment. Mining's no different in that perspective. You need a combination of instruments because you're doing a particularly large capital raises. Very few management teams can pull it off, and very few non-bank lenders have the expertise to lend that money. It should be difficult to use other people's money to go and build something. It seems to me that it's getting even more rarefied air to put together the management teams and the finance syndicates. And when markets are good, yes, you can do things like Silvercrest did, incredibly low capex, all equity. A great result, very low risk for the shareholders. Otherwise, you see scenarios where large amounts of debt on marginal projects, and you see they've materially underperformed. So that's the only way I can think of that you can finance. I'd avoid the streams as much as possible. I'm not saying there's circumstances. If you think your resource is small, take a stream. If you think it's a generational asset, you're giving up huge upside for no value. But conventional debt, equity, streams, you've touched on the key ways to raise money, and if you can find an alternative, I'm open to hear it.
Charles, look, you've been around this sector for a while. So have I, but I think you've been around a bit longer than me. How much has it changed in your eyes from initially working for a big major and then moving down into the junior space and now building Heliostar into, let's arguably call it a mid-tier, or at least an early stage producer? How much has the market and sector changed in the way that you need to manage a company?
Yeah, I think we're on the runway. We have the opportunity to become a mid-tier. I look forward to delivering that over the next few years. Quite old-fashioned, that view. Yeah. Human nature doesn't change, so therefore nothing's changed in that sense. But I think your question is, I think mining we used to have the smallest target strategy. Let's just, hopefully be somewhere not in the public eye, go and create value and be left alone. And that means that the combination of that combined with the fact that we're scientists, engineers, operators, we're not naturally public communicators or strong communicators, has meant we've always kept a small target strategy And in the long term, that's been to our detriment. Because, again, going back to human nature, I sort of call it the mob wife syndrome, in that look at the way we buy meat from supermarkets. I grew up on a farm. I know the life cycle that comes from producing protein. But in supermarkets, we want it sterilised package with a lovely light on it, looking the least like the animal that it originally was. We're exactly the same at mining. We want to fly it. We want to be on a phone. We want to live in a house. The average American uses, I think it's 6 F-150s worth of minerals every year. But we choose not to acknowledge that. And so, as an industry, in keeping a small target, everything comes with a cost in life. Yes, you can eat protein, but animals have to die so that you can do that. Yes, I want to live in a house and I want my kids to go to a good school and I want to have opportunities. The environment has to be negatively affected to do that. We have to explain that a mature community and society has to have an environmental impact to improve your standard of living and has to work well to minimise that. And modern mining is one of the most incredible stories of minimising its environmental footprint and minimising its negative safety consequences. Yet we don't celebrate that, and we suffer massively in the public eye for what we do because people don't want to acknowledge that if it's not grown, it's mined, and that mining is got considerably safer and a considerably reduced environmental footprint. And we're terrible at telling our role in improving the standard of lives for ourselves and our children.
Unfortunately, yes, one of the issues why we don't see a whole lot of new investors come in. But what about from the financial model sense, though? Money is harder. Money, or at least it seems to be harder, in my eyes, for companies to raise to build these companies. So how much has that changed in your time in the resource sector?
Yeah, I think you're going to hate me. I think money should be hard. Like R&D should only get the highest risk capital, and exploration is hard. I think what's changed for us is when I started getting capital, there wasn't many other ways for people to speculate. With the addition of online gambling, crazes like the cryptocurrencies where you can trade nothing, they're all meme stocks in my opinion, even Bitcoin. It's a clever software, but it's physically nothing. I touched on sports gambling, you can trade now so much more easily than you could in the past. So I think there was a group of people who would finance speculation for the thrill of it that can get that thrill in easier ways, meaning it's harder to get capital. And as we touched on that push factor at the beginning of the call, with that lack of funding model of the brokerage, you don't have an institutionalized support. So for me, I've built my business much more on high net worth investors than I think might have been done 20, 30 years ago. So I think to answer your question, relying on less high net worth investors and the few gold funds, because I'm in the gold space, that continue to invest throughout the cycle and will pick management to support. So less reliance on retail, no reliance from my perspective on Canadian retail. Come here to the US, go to Europe and look for those rarer long-term high net worth investors that believe in us technically to deliver a return on their investment.
Very interesting, Charles. Thanks for sitting down with me. Thanks for taking this different, tact. It's not something we usually talk about on mic, but I did want to get some of your comments because I find them just fascinating and it's true insights in the sector. So thank you.
Yeah, sorry, a little bit of a ramble and maybe slightly long-winded, but what we're seeing, what we've just talked about, is literally defining the business decisions that we make at Heliostar. So you're right, it does have a tangible and immediate impact on the way we try to operate.